You are listening to The Investor Way with Sam Ball and Jonathan McEwen. If you enjoy the show, please subscribe and follow us on Twitter at TIWTweets.
Hello and welcome to The Investor Way with myself, John McEwen, and my co-host, Sam Ball. This week on The Investor Way, we have DS Smith, Ashtead, Experian, Berkely Group, Inditex, and our US company of the week is Adobe. Sam, I think we've got a correction to start off with.
We absolutely do. And the correction has come in from Amateur Investor on Twitter. And I do question how much of an amateur he is compared to us after this. But we commented last week about the Halfords net debt increasing. So we assumed that that increase in net debt had been used to fund the auto centre acquisitions. And he said the Halfords net debt is lease liabilities. Excluding lease liabilities, it has a net cash position, and National Tyres was funded by a share issue. So that is the correction. I'd say it probably doesn't really change my view of Halfords that much. And I still don't like the auto centre strategy, but if it's not being funded with debt, I dislike it less.
A little bit less, yeah.
Yeah.
Okay.
Right, shall we start
Good.
with this week's and try and get them right?
Yes. Yeah, so DS Smith, the FTSE 100 box maker, had their full year results out this week, with full year revenue up 26% to £7.2 billion, with a 5.4% increase in like-for-like box volumes. Price rises managed to offset rapidly growing input costs, leading underlying operating profits to rise by 29% to £616 million. In terms of geographies, Northern Europe saw revenue growth of 21% to £2.8 billion, with strong showings in Germany offsetting declines in the UK. Underlying operating profit was up 5% in the region, coming in at £139 million, with price rises again offsetting the increased input costs. In Southern Europe, a return of tourism helped volumes recover, with revenue up 33% to £2.7 billion, and operating profit grew 53% to £324 million. Moreover, the acquisition of Europac added to the improved profitability with a 12% return on sales. In Eastern Europe, revenue was up 30% to £1.1 billion on the back of increased volumes. Despite this, operating profits were flat at £73 million, with a lag in the higher paper prices and increased packaging prices. North America, revenue grew 14% to £597 million, and underlying operating profit rose 31% to £80 million, with better paper and packaging prices. The new Italian site is now fully online, and new Polish site is expected to come in online in the next few weeks, adding around 3 to 4% more packaging capacity, and 80% has already been pre-sold. The group is planning a further £500 million in capital expenditure, and that's 20% ahead of last year's figure. The group's free cash flow increased by 7% to £519 million, and net debt fell to £1.5 billion from 1.8 a year earlier. That equates to around 1.6 times EBITDA. Going forward, the group expects corrugated box volume growth of between 2 and 4% in the current year, with ongoing price increases and careful cost management offsetting inflationary pressures. Final dividend of 10.2p was confirmed, bringing the total to 15p, which is an increase of 24%. In terms of valuation, DS Smith has a market cap of £4 billion and trades at just over 9 times earnings, with a prospective dividend yield of 5.1%. My impression, I thought these were very good results given the tough comparators, and proving that DS Smith is managing to push up the prices without impacting the volumes, which is something that we'd previously discussed and questioned. I suppose the big question now is whether, in the face of a recession and decreased consumer demand, volumes are going to be hit significantly with a slide in e-commerce as consumers rein in the spending. And 80% of overall volumes at DS Smith do come from the fast moving consumer goods and consumer related sectors. So I suppose that is the big thing or big issue facing DS Smith. I think it's probably or possibly a little bit overdone, and it's certainly reflected in the price, because DS Smith is cheap at the moment and it looks like a very solid business. So it's definitely one that will be I think it's already on my watch list, and it'll be staying there and possibly taking a position. But it certainly looks good value. But it is that uncertainty that I'm sure is depressing the price. Sam, your thoughts on DS Smith?
I like it. I think these are a very good set of results. I think the fact they have been able to just pass on the inflation to customers is very, very good. I agree. The current price to earnings, it's very, very cheap, and with a very high dividend now, 5.8%, and this is a well covered dividend too. I mean, it's just a very, very good dividend. Yeah, I agree. It's been a bit overdone, but I just like it. I think it's just a good, well run business, and I think. What was it that they've talked about before, where they plan to drop the amount of paper that they produce in-house down to 60%. And that means when the commodity prices are higher, it costs them more, but when they're lower, they benefit. Yeah. In the current environment of inflation and high commodity prices, I didn't like the idea at the time, but I like it even less now. I think this demonstrates why it's probably better to have that vertical integration. So I do think, I don't know if they are, but you'd hope that someone's reconsidering that. Yeah, especially in the near term. Yeah, but if they did drop it to 60%, it's not a disaster, and you're still producing most of it yourself. And I guess it means you've sort of got the win-win, where when it's more expensive, you've got the benefit of the 60% you're producing yourself, and then when it's less, you get the benefit of what you're buying in. Yeah. But I just think it's better for the business to have that control. Yeah, so, and I suppose they might have argued that. Obviously not recently, but over the last few years, it had been a bit of a drag on the business, whereas now it's actually benefiting the business a lot. But yeah, it's I suppose they're quite lucky then that it has changed so quickly. Yes, because because if it had been a drag and like it taken years to much longer to get to where we are in terms of the commodities and the inflation, they could have already done that. Whereas now, with it changing so swiftly, it probably means someone can rethink it and actually think, well, actually, just because things were quite nice and rosy then, didn't mean it was going to stay like that forever. And I just think for longer term planning, it's better to have. You want the highest proportion of paper produced in house. But very, very good set of results, and they've had a very good year. I agree that if we go into a recession, you would expect to see some sort of drop, as you get that knock-on effect from like people purchasing stuff. But in the longer term, they probably do have quite a lot of tailwinds with like e-commerce and then people moving away from plastic packaging. So I think at 8 times earnings, I like it a lot. Yeah. Yeah. Would you buy shares? I don't know if I would. Yeah. But I do like it. Opportunity cost or? Probably opportunity cost. Yeah. But at a P of 8, it's just one of the things where you just can't own everything. Yeah. Because I've only got like 10 to 15 positions in my own portfolio. Is this in the top 10 to 15 businesses we've ever looked at? I don't know if it is. If I had a 50 position portfolio, it would be in there. It'd be one of them. Yeah. No, fair enough. I mean, there are lots of, I would agree with you. I say there are lots of companies like that at the moment that I do like. I think valuation wise, they're very, very attractive, but it's the side, portfolio allocation and things, it's difficult to justify some of them. Although when you discuss them with people, you think that sounds like a good business at a good price. There is like a good number of these sorts of stocks on the FTSE. If you go through the full FTSE 350, I reckon if someone gave us like a few £100 million a fund of like 30 or 40 FTSE 350 positions, I think we could have a lot of business. So if anyone's listening with a spare few £100 million, corrections aside, we would be willing to do it. Halfords wouldn't be part of it though. Halfords would not be part of it, but DS Smith would. Yeah, well, yeah, but but seriously though, it feels like it's a stock picker's market, and there are lots of attractive stocks at attractive prices, particularly in the FTSE 100. Yeah, it's something we'll come on to later actually, because it sort of links into what I've got in my notes about Inditex, but spoilers. Well, that's not then that's not UK. Well, that's a good point, actually. Yeah. But anyway, it's not a US company. So anyway, let's move on. Ashtead. Ashtead, yes. So we have covered them before on the show. They hire out diggers. They're very big in the US and Canada. They've come out with their full year results, and full year revenue met expectations and rose 19% to $8 billion. And all the figures are reported in dollars. reflecting a 22% rise in rental revenue and growth across all geographies, ignoring the impact of exchange rates. This was a 23% increase compared to pre-COVID times. Ashtead is expecting rental revenue to rise 12 to 14% in the current year, as growth in the US and Canada offsets a decline in the UK as pandemic-related medical demand wanes. So a lot of, about 30% of the UK revenue was coming from the NHS. The group spent 414 million on share buybacks. I'll just check the market cap actually, so we can see how big that 400 million actually is. So it's a 15.7 billion pound company, so $400 million on share buybacks isn't really very much. We break them down by sector. In the US, sales increased 22% from 5.4 to 6.5 billion, and they said this reflected their efforts to broaden their end markets and a strong performance in specialty markets, and this fed into a 28% increase in operating profits to 1.9 billion. In the UK, sales rose from 838 to 986 million, although this was in part due to the NHS, which accounted for 30% of the revenue, as mentioned before, and operating profit increased 46.8% to 118 million. Revenue in Canada rose from 383 million to 499 million. However, that's mainly because it was up against weak comparatives, and operating profit increased 53% to 114 million. Capital expenditure was $2 billion net of sales proceeds. So the capital expenditure is quite high in this business because they're letting out diggers and stuff like that. They do have to keep renewing the fleet. Supply chain issues meant the group delayed some of its fleet sales. As at 30 April 2022, the fleet was worth $13.5 billion with an average age of 40 months, and they're expecting to spend between 3.3 and 3.6 billion in the year ahead. Free cash flow fell from 1.8 to 1.1 billion, which reflected capital expenditure that was more than double last year. Shareholder returns, together with acquisition costs, outpaced free cash flow. And that meant that underlying net debt rose from 4.2 billion to 5.2 billion, or 1.5x underlying cash profits, which is within their target range. In terms of the valuation, the business trades at a PE of 13, and that compares to a 10-year average of 15.3. And the business has a prospective dividend yield over the next 12 months of 1.8%. This is obviously a very, very good set of results. If you look at the long term, the business has been a very, very good operator. I do have concerns about how capital intensive it is, but I think as long as infrastructure spending and development spending carries on, this is a business that would probably do okay in an inflationary environment, just because I think they would very easily be able to pass on the costs, you know, like digger hire and stuff out onto customers, because you'd expect that anyone who's looking at the alternative of just buying the digger, the price of that are going to increase in line with inflation as well. But I don't, it's not a market I really know well enough to be able to assess the growth prospects of it. So a PE of 13, it might be reasonable, but I don't know. I struggle to assess that part of it. John, what are your thoughts on the results and the valuation?
Well, I mean, they're certainly very good results. And actually looking historically, Ashtead has delivered significant growth and value, I suppose, value to shareholders as well. And yeah, these numbers being 23% increase in revenue ahead of the pre-pandemic figures is really impressive. I suppose one worry would be sort of if infrastructure spending is cut back and we're in sort of a prolonged recessionary period, then even if they can pass on the costs, if you've got infrastructure projects being cut, across the world and particularly in the States, then that is going to hit Ashtead hard. I guess it's probably reflected in the price. And if you look how much the shares have pulled back since the autumn or since the winter, they're down about 43% this year. So I guess it probably is sort of baked in, but they have that history of delivering. So I don't know. I think it is difficult. And, like you say, I know you're not particularly keen on those businesses which are very capital intensive. So I don't know. I think it would probably be a miss from me, but it certainly looks like a quality business that has a an exceptional track record, actually.
Yeah, it's the industry that's a problem, not the business.
Yeah. No.
Right, shall we move on to Experian?
Yes. Okay. So Experian, for those who don't know, is a credit rating agency. It's the biggest listed in the UK on the FTSE 100. They had their full year results out last month, with underlying revenue rising 17% to $6.3 billion, in line with guidance and reflecting organic growth of 12%. Operating profits were up 19% to $1.4 billion, with a strong performance in the consumer services business, and that's across all of their geographies. In a little bit more detail then, in the business-to-business sector, organic revenue grew 9% with strong volumes in data and health with COVID-related tailwinds. Meanwhile, consumer services saw organic revenue rise 22%, with free memberships growing by over 17% to 134 million. In North America, which accounts for 65% of total group revenue came in at $4.1 billion, representing a 13% increase and double-digit growth in business-to-business and consumer services. There's a fall in business-to-business consumer refinancing activity. However, this was offset by growth in the short-term lending data and the buy now, pay later sector. Both free memberships and premium upsells rose, and operating profit for North America was up 13% to $1.4 billion. In the UK and Ireland, revenues were up 11% to $847 million, with strong growth in consumer services and 1.5 million new free members, whilst business-to-business revenue grew with new business from sectors like buy now, pay later, traditional banking, along with fintech. Operating profits were up nearly 53% and margins improved to 22.2% from 16.7%. In Latin America, revenue grew 17% to $791 million, and the economic recovery meant that the business-to-business revenue rose 14%, whilst consumer services grew by 40%, helped by the expansion of the group's debt resolution service. Operating profits were up 27% to $223 million and margins up to 28.2%. In Europe, Middle East, Africa, and Asia Pacific, revenue rose a more modest 3% to $507 million, and the ongoing rationalization of the portfolio meant the division broke even compared with a $27 million loss last year. Underlying free cash flow was up 18% to $1.3 billion, and net debt fell slightly to $4 billion, which equates to around 1.9 times underlying cash profits. The group announced a second interim dividend of 35.75 cents, which represents a 10% increase. Experian expects organic revenue to grow between 7 and 9% this year, with modest margin improvements. In terms of valuation, Experian has a market cap of £22 billion and trades at around 22 times earnings. I thought these were very good results, particularly from the consumer-facing business, which was the standout performer. And the cash flow conversion is something that's also very impressive at 109%. And you can see, even as we move into what may be a recession, you can see some other parts of the business growing, like the buy now, pay later. And that, I think that's probably something that's part of the economic cycle that we're in. What would be holding me back from investing would probably be a more comprehensive understanding of the industry, credit rating, and the data market. And I think that would make me hesitant. The other thing would be that, as we saw with Equifax a few years ago, that it's sort of, I suppose, ripe. It's a target for cybercrime. And I know that's something that the business has been investing, but it is a massive risk for a company like Experian. So I probably wouldn't be buying shares. They're not cheap, but if you look at the numbers, you can see why they're priced as they are. Sam, your thoughts on Experian?
Do we know what the buy now, pay later bit is?
So I think it's essentially the way that the sort of the consumer part of the business works is when you go onto the website, you put in all of your details, they do the credit check, and then they sell you credit products. So I suspect it's probably through that portal that they're selling you buy now, pay later products.
So is this, you can buy their own products with buy now, pay later, or they have a separate, that's a separate product they're offering that you can buy from them? So it allows you to take buy now, pay later.
I think it operates like a portal, so you can then get those sort of products from different providers, but they sort of almost take your data and then match you up with competitive sort of products. I think that's how it works. Let me just have a look.
So is that what the buy now, pay later bureau is?
Let me just have a look. Experian,
because I saw that on the website, but I wasn't sure if that was a separate thing. And they had a buy now. They actually had a buy now, pay later, like, like Afterpay. I didn't know. So it says here they've got, in the spring of 22 will debut the buy now, pay later bureau, a first of its kind specialty bureau, which will provide visibility so lenders can help further financial inclusion and better risk assess while preventing negative impact to consumer credit score. Then it talks about how wonderful buy now, pay later is. Will allow BNPL users to furnish data on all types of point of sales products, enabling a comprehensive view of consumer payments, including the number of outstanding BNPL loans, total loan amounts. So it gives, it's what they're doing now, but for buy now, pay later. So it gives the buy now, pay later providers that data on how it's working for them.
Okay.
I think I get it now. So they've not launched a buy now, pay later. They have, but like it sits on top of it, like, or in the background of it, collecting the data, and that's what they're selling. So I guess if you're like a store and you're offering buy now, pay later, if you're already using Experian, it would make sense to get the buy now, pay later product so that you can get the actual data of how well buy now, pay later is working for you.
Yeah.
So that's a smart move, actually. That complements the rest of what they do quite well. Right. Okay. Right. So now I understand what that is. I think it's a good set of results. The organic growth is very good. It's at about 9%, and then they've guided for a similar 7 to 9% again this year. I think the results are good. I'm not sure about the 23.5 times earnings valuation. That's quite expensive for a business growing 7 to 9% a year, especially when we're getting, we're currently at 9.1% inflation now.
Yeah.
So it seems quite expensive for something that's increasing in line with inflation.
Yeah. What do you think of it as a business? Is it a business that you like?
It's a business I struggle to understand, but I'm slowly getting
Fair
there.
enough.
But yeah, I don't know about like. It's probably a business that just goes in the too hard pile for me. But the results are good. Yeah. I mean, this is probably the second or third time we've looked at it. I feel like I'm starting to understand it a little bit better. But where there's some businesses where you look at it once or twice and it's like, well, I think I get that. I might have to look at this another 3 or 4 times before I fully appreciate what it does. Yeah.
So not one that you'll be investing in?
No.
Not anytime soon?
I mean, to be honest, even if I felt like I understood it more, maybe if I understood it more, I'd appreciate the valuation more, but it just seems quite expensive in this environment.
Yeah, no, fair enough. Okay, on to our next company, which is a bit easier to understand, Berkely Group.
Yes. Yeah, so Berkely Group, they are a developer, and we do like our house builders on the show. These are at the higher end of house builders, which you'll see when we get to the average selling price. So they have come out with their full year results, and revenue was up 6.6% to 2.3 billion, as they sold 33% more homes the previous year. Higher operating costs and a lower average selling price due to the type of property sold meant operating margin declined 1.2 percentage points. However, driven by higher profit from joint ventures, pre-tax profit rose 6.4% to 551.5 million. Pre-tax profit is expected to come in at 600 million next year and 625 million for the 2 years thereafter. Berkely continues to target 282 million in shareholder returns per year, in either dividends or, that's a very specific figure, in either dividends or buybacks. 63.7 million has been returned so far this year, with more information on the dividend coming on 11th of August. The group warned on volatility in the housing market, but sees prices continuing to offset cost inflation. I'd caveat that by saying I think that's only as long as people can afford to take out the mortgages on them.
Yeah.
But I'm sure they're more than aware of that. They sold 3,760 new homes, and that was up from 2,825 the previous year. at an average selling price of £603,000, and that's 22% lower. Oh, the average selling price is 22% lower than the prior year, which reflects the type of property sold. Underlying sales reservations are 25% higher than last year and slightly ahead of pre-pandemic levels. Forward sales, which reflect sales due to complete within the next 3 years, rose 27% to 2.2 billion. The land bank rose from 63,270 plots to 66,163 plots, and now has an estimated future gross profit of 8.3 billion, up from 6.9 billion. As at 30 April 2022, inventory totaled 5.1 billion, and that reflects an increase of 1.5 billion, largely driven by the acquisition of St William. Inventories include 738 million of land not under development and 4.4 billion of work in progress and completed homes. The group had a free cash outflow of 130.8 million, driven by the acquisition of St William. Net cash at the end of the year stood at 268.9 million, down from 1.1 billion. This was driven by the free cash outflow, higher investment in joint ventures, and increased shareholder returns. Land creditors rose from 388 to 801 million, with 81 million due in the short term. In terms of the valuation, the business has a prospective dividend yield in the next 12 months of 6%, and it trades at a PE ratio of 8.84. I'm trying to get a gauge of how expensive the homes are, because the average selling price of 603,000 is a lot, and it's about, I think it's about 250 to 300,000 is the figure for most of the ones we look at, like Barrett, or Persimmon. But these guys are mainly, obviously where I am in the north, a 600 grand house will get you a lot, but these guys are mainly in the south and the Midlands, where the prices are a lot higher anyway. So they probably are slightly bigger homes, but I don't know. I mean, 600 grand in London, it gets you a wardrobe, doesn't it? So it's difficult to judge. But anyway, I thought these were very good results. I think the valuation's pretty reasonable at 8.84, good dividend, like virtually all the other house builders we look at. I guess if you think the party's going to continue, it's pretty reasonably valued. But the concern is if interest rates start going up a lot, can people afford to take out the mortgages? And with an average selling price of 600,000, they would be hit, I think, harder by than the other ones. And also they don't have the benefit. Their houses will be outside of the first-time buyers schemes as well. So they won't have the benefit of that. So they probably, at that end of the market, experience more of a drop-off or a drop-off sooner.
Yeah.
I think.
Yeah.
What do you think, John?
No, I would tend to agree with you. And I think, I own a house builder, which is Redrow. And I think that's probably something, or probably a reason why I would choose one of the other house builders over Berkely Group. And the share prices of all of the house builders have been depressed massively. And I can only assume that is partly on the basis of the macro situation and interest rates rising, and I suppose the affordability, and then the value of the house is also falling, and that essentially all feeding through to the bottom line of these house builders. I would probably keep holding my Redrow shares. I think they're still very cheap, despite what's going on in the wider economy. Probably would just hold them for the very long term. But I think you'd certainly have to be in it for the long term if you were buying shares in house builders now.
Yeah, I do wonder if these guys could be a bit of a canary in the coal mine for the other house builders. I think you'd get a drop off with Berkely first before you got in with the others.
Yeah. No, that's true. And they have all pulled back so much anyway. But I suppose in terms of the fundamentals that they're what they're reporting, you're right. But it feels like the shares are already, it's already baked in that they're going to drop off. But it's interesting. How do you feel about the house builders now? I mean, would you consider buying shares at these really depressed multiples?
I probably wouldn't want a house builder in my portfolio anyway, but I think in the long term, I still like the tailwinds for the industry. I wouldn't not buy it because of what's going on at the minute. Yeah, I wouldn't not buy in a house builder at the minute if you like the business and you like the valuation. And bear in mind, they are much better businesses as a group generally than they were prior to 2008. I think to try and make a macro call on it, there's so many different ways it could pan out. You could get to a 10% interest rate, a lot of the house builders are probably going to get screwed because the house prices are so unaffordable at high interest rates for anyone looking to get on the housing ladder. But then equally, you've got so many people that have like geared up in the last however many years of low interest rates that if the interest rate does go up to 10 or 15%, which it has done in the lifetime of a lot of listeners, but if it does go up to that, then how many people who've remortgaged you just get some potentially quite catastrophic knock-on effects because you get so many people where, if you're on a variable mortgage and it's like, oh, you've got a mortgage that's coming up for renewal in 2 years and it goes onto a variable one or something, like, yeah, absolutely, you're screwed. And then so much of like the national psyche is tied into property prices. So if you get a drop in property prices, you just get to that point where maybe they've raised the interest rate to 10% to fight inflation, but because of the knock-on effects would be so catastrophic because they left them so low for so long, they might just decide, well, actually, we're better off with 10% inflation a year because we just cannot have interest rates that high. And then you've got the government debt. Like, it's so complicated. But to try and say, well, I'm not going to have a house builder because I think this is what's going to happen to the interest rate in the next 2 years. Like, the governor of the Bank of England probably doesn't even know what's going to happen to the interest rate in the next 2 years. So I wouldn't try and make that call.
No, fair enough.
Would you ever think of selling your house builder because you're worried about what interest rates are going to do?
Probably not. I mean, it is a much, I mean, when I bought the shares, it was much longer term view anyway. So you always knew that you could have sort of the 2008 situation happening again. But like you say, they're in a much better state than they were back then. And I think ultimately it would come down to the structural side of things, that we've got a lot more people than we have homes, and we need more homes. And under whichever government is in power next, you'd think that they're going to have to work with the house builders realistically to deliver them.
Yeah. Should we move on to Inditex?
Yes, so it's our Spanish company of the week and owner of Zara. They had their first quarter results out earlier this month, with sales rising 36% to 6.7 billion euros and EBITDA up 55% to 1.9 billion euros. Alongside these impressive numbers, there was also an extraordinary charge of 216 million euros to provision all expected expenses from Russia and Ukraine. Gross margin remained very healthy at 60.1%, which was up 20 basis points, and that's the highest it's been in 10 years. And while operating expenses were up 24% at 2.1 billion euros, this was below the sales growth. The group also pointed to inventory levels increasing 27% compared with Q1 in 2021, allowing for increased product availability in the face of possible supply chain tensions. The group's net cash position was up 29% to just under 9.2 billion euros. And they drew attention to their strategic pillar of full integration of stores and online business, alongside sustainability and digitalization drives. They've set aside 1.1 billion euros of capital expenditure for 2022 and aim for online sales to exceed 30% of total sales by 2024. Going forward, they're guiding for a strong spring and summer season, with store and online sales from the 1st of May to the 5th of June 22 increasing 17%, with 90% of their stores being open. In terms of valuation, Inditex has a market cap of just under 67 billion euros and trades at 17.8 times earnings, compared with a 10-year average of 25. I mean, I thought this trading statement for the first quarter was really impressive. I mean, the numbers for a retailer, I think they must be the best that we've looked at compared with all of the UK retailers, or sort of clothes retailers at least. And it is reflected in the price, but I don't know. I don't think for numbers like that, I don't think 17.8 times earnings is all that expensive. I suppose, again, it's that sort of the macro side of things and people expecting a recession and companies like Inditex, Zara to be hit. But gosh, they are good numbers, and it's a business that I like. And the more times that we cover it, the more I like it. So I think it's definitely one for the watch list for me. Yeah, I think it's a great company. What are your thoughts, Sam?
I think they're very, very good numbers, but I think to sit there and say, well, it's worth 17 times earnings if they can put up numbers like this every year, I don't think they can. But they are excellent numbers. I think that the number that actually stood out to me was the gross margin of 60%. To do that in that industry just speaks to what a good operator you are, I think, because that's a very high gross margin in a very low margin industry. It's really, really impressive, that number. I think at 17 times earnings, I know it's below what it's historically traded at. I know it's a very good business. I know it's got a very good dividend as well, actually. Is it like 3 or 4%? Yeah. So I can see why people like it. And compared to where it's normally traded at, 17 is cheap. But I just think in this environment, it's just still quite expensive. And I think when you look at the other opportunities that are out there right now, I don't know if I'd pay 17 times earnings for Inditex. A year ago, it was a different, if it had been at 17 times earnings a year ago, it would have been a very different conversation. But now with the valuations we're seeing, I still think it's quite expensive. If I was going to pick a retailer, I'd still be picking Next over Zara.
Okay, and let's just, for reference, let's just have a look at the valuation of Next. Yeah, I suppose, this is a difficulty because Next is, as we said before, very high quality, and it's under 11.5 times earnings.
Yeah, and it's got a much higher proportion of the sales are online. I think like 60% of the business is online now, which I quite like.
Yeah.
I think Zara is more like 25-30%.
It's targeting 30%.
Yeah. It's to me, it's the opportunity cost, isn't it? If I was looking in that sector, I'd be thinking, well, hang on, Next at 11 is a bit, to me, it's almost a no-brainer territory. Whereas Zara at 17, you do have to think about it.
Yeah, fair enough. And would you take a position in Next?
I would. It's probably the business that I don't own that I'm closest to owning.
Okay.
I came very, very close to starting a position after the last time we looked at it a couple of months ago, and I didn't quite get there, but yeah. I really, really like Next. I think it's a fantastic business. I think it's a very, very reasonable valuation. I think it's probably the company on my watch list that's closest to moving off of the watch list. If someone put a gun to my head and said tomorrow you've got to start a completely new position, it would be Next.
Okay, fair enough. I mean, companies I like both of them. Will I be buying either? I think they're both on my watch list, but I am impressed with Inditex.
There's probably ABF to consider as well.
Yeah,
I know it's a bit. I like it. But yeah, that's the point. There's some very, very good businesses that are doing, similar things to what Zara is. So if it's going to trade at that kind of premium, I don't know if it's just trading at that. Actually, no, because it's listed in Spain, isn't it?
Yeah.
And it must be one. I don't know what the businesses are like in Spain. I don't know.
Let me just fact check.
I think it's Madrid.
Yeah, I think it is.
But it might just command a higher valuation because there's less quality businesses in Spain. I don't want to jump to that conclusion because I don't know any of the businesses that are listed in Spain, but I can't imagine there's many as good as Zara. And that could be why it's at a bit more of a premium, just because where it's listed. If it was in the UK, I don't think it would have that much of a premium over Next and ABF.
I suppose it's almost like the Nestle versus the Unilever. It's it trades at considerably more, but recently it's been delivering much better numbers.
Yeah, but with Zara, I agree. Nestle's been doing better than Unilever, but I think with Zara, I wouldn't say it's been delivering that much better numbers than Next
to warrant that. That extra price. Yeah, fair enough. Okay, on to our American company of the week.
Yes, so it's a company that we should all be, or I'd assume we're all fairly familiar with, Adobe, who do the PDF software and lots of other software stuff. So they have come out with their Photoshop as well. Yeah. Do you use Photoshop much?
I don't, but
your Instagram pictures.
No. I don't know whether our logo was made on Photoshop. It could well have been.
It probably was. I mean,
probably
I'd have to speak to the guy that designed it, but it probably was Photoshop. So yeah, they've come out with their Q2 results, and they achieved, all these figures will be in dollars, and they achieved record revenue of 4.39 billion, which represents 14% year-over-year growth, or 15% in constant currency. Diluted earnings per share was $2.49 on a GAAP basis. We won't bother with the non-GAAP basis. GAAP operating income in the second quarter was 1.53 billion. GAAP net income was 1.18 billion. Cash flows from operations were 2.04 billion. They repurchased 1.9 million shares during the quarter. I'll see if I can get the number of shares outstanding, because otherwise that's just a useless number. It's about 480 million. So repurchased 1.9 million, so not a huge amount. Digital media segment revenue was 3.2 billion, and that represents 15% year-over-year growth, or 16% in constant currency. Creative revenue grew to 2.61 billion, representing 12% year-over-year growth, or 14% in constant currency. Document cloud revenue was 595 million, representing 27% year-over-year growth, or 28% in constant currency. Net new digital media annualized recurring revenue was 464 million, and digital media annual recurring revenue was 12.95 billion. Creative annual recurring revenue grew to 10.82 billion, and document cloud annual recurring revenue grew to 2.13 billion. Digital experience segment revenue was 1.1 billion, representing 17% year-over-year growth, or 18% constant currency. And digital experience subscription revenue was 961 million, representing 18% year-over-year growth. They provided the guidance for the year as a whole, and they're guiding for revenue growth for the various segments of 17 to 19%, and earnings per share of $13.50. They are currently trading at a share price of $387, and that puts them in a market cap of 183 billion. For the trailing 12 months, that puts the PE ratio at 37.86. We could try using the guided figures to 2022 to see if we can try and get it to a bit of a lower number for them, so that people can just see if we can try and justify the valuation a bit more. So if we use the guided figures, which is about 30% higher earnings per share, that would put them at a PE ratio of 28.6. My view is these are excellent results. It's an excellent business, excellent products, I think incredibly strong moats. But the 17 to say they're going to grow at 15 to 20% a year, at a PE of 37, even if you think that's coming down to 28, you might maybe argue that it doesn't matter that the revenue growth is only 15 to 20% because of the nature of the business, that you could say, well, maybe more, virtually all of it's just going to go straight to profit. But it's a similar I don't know if I'd be, I just think in this environment, that's still very, very expensive. And I think as well, if you're starting to get into arguments about how it's going to grow into the valuation, that's just not a conversation I'm very comfortable having about a business that's got a market cap of 180 billion. Maybe it could end up being $1 trillion business, but I just don't like paying such high multiples for businesses that are already so big. John, what are your thoughts on the results and the valuation?
I think they were good results, but it would be the valuation for me. That's what I would find very tricky. And there are some other big, mega caps like Adobe that I would probably choose before Adobe if I was looking for those sorts of companies. For that reason, I probably wouldn't go for it. Like Microsoft, I prefer Microsoft over Adobe, being one example. But yeah, I have no doubt that it's got very deep moats and it's a quality business, but valuation is the key thing.
Yeah, and it's a P of 37.86, and that's after a 44% drop.
Yeah, that's right.
They probably need to drop at least another 44% for me. So.
Yeah, which probably isn't happening. Yeah,
you just don't know in this market. We could cover it in 6 months' time, and it could be that.
Yeah, and then you might take another look.
Yeah, no. If it was at more like 20 times earnings, I would probably take a look at it. But I still think it's very expensively priced, really, even after the 44% drop, which I don't know who was paying. What would that have been like? Someone must have paid 70 or 80 times earnings for this, which... Right then, so of the 6 businesses we've looked at, DS Smith, Ashtead, Experian, Berkely Group, Inditex, and Adobe, if you had to buy one, which one would it be?
Out of these companies, I will go for DS Smith, and I do like Inditex, but DS Smith at 9 times earnings seems more of a no-brainer, I think.
To be boring, I would also go for DS Smith. So I think that's everything then.
Yes.
Right, well, thank you very much for listening, and we'll see you all next week.
See you next week.
Thank you for listening to The Investor Way. To get in touch, please follow us on Twitter @TIW_tweets. This podcast is for entertainment purposes only and does not constitute financial advice. Neither Sam nor Jonathan are financial advisors. For investment advice, please consult professional advisors.